Hello and welcome to this week's episode for Spy Trader Now. I am your host. My name is Ken. Today is April 19th, 2023. Our model portfolio is up year to date 7.32%. This is how our portfolio is currently positioned. And you can see that we have just a small option position right now. 81% in large cap stock, which is the ETF SPY. Here at Spy Trader Now, what we do is we take investment capital, not trading capital, although it's called Spy Trader Now. We do this with investment grade capital, and we want to beat the returns of the S&P 500 buy and hold investor. Their portfolio is currently up 14%. Our portfolio is up 7%. So we're not accomplishing our goal so far this year in 2023. Our goal is to beat that return before the year is out. And I'm going to show you in this video what I have done this week, because this week was an incredible week for the stock market, and what I plan on doing in the future on how I am going to accomplish this goal to beat the returns of the buy and hold investor. So with that, stay tuned. Here are some past results for Spy Trader Now. In 2022, we had a good year, up 21% compared to down 19%. 2021, great year. 2020 was unbelievable, where we doubled the portfolio. If you want to see how I do this, go ahead and hit that subscribe button, ring that bell, and smash that like button down for me right now. Thank you. Last week, the S&P 500 for the week lost 2.05%. Here are the trades that we made for last week. You can pause the video and go ahead and read these if you like. But basically, we made two trades during the week. On the 16th, we bought 3 long calls, and here's the exact calls that we purchased. And on the very next day, on the 17th, what we did was we buy to close the 2 covered call positions because the market had softened. When we did that, we had profited on that by $1,144. So we did very handsomely by taking that in the money covered call option, and then when the market softened, ended up closing those positions buy to close. Here are some of the trades I've made in the recent trades I've made in 2023. There are 2 open positions. So currently we have the shares of SPY that we purchased at $448.76, and the current price of SPY is $436.70. So that position is upside down right now by $2,452. In our case, our price is adjusted because we've made money on options during this time frame. So our break-even cost, I'll show you that later on in the presentation, is much more favorable than just owning the shares outright. And then we also have the call that I just placed, which is only 1% of the portfolio. For the total cost was under $1,000. Currently, this particular position, we're losing $300 or 33%, but this position is still open, and I'm expecting that bounce, and I'm expecting this to give us a decent profit when everything is said and done. All we have to do is have the market go higher than its current price of $436.50. And then this will start to be a profitable position for us. Here is our equity curve of our model portfolio for 2023 year to date. Here is the equity curve for the buy and hold investor year to date for 2023. And here are the 2 equity curves combined. Now keep in mind, we are trying to beat the returns of the buy and hold investor with our strategy. So we had a conservative portfolio going into last week. That is why the S&P 500 dropped more on a percentage basis than our portfolio. We still had a drop, but we did not drop at the same rate. Now I'm positioned in such a way that if this market does indeed bounce like I'm expecting it to do, we will come up at a faster rate than the S&P 500 because we have the shares of SPY, and in addition to that, we have 3 call options, which will accelerate. And we still have a decent cash position. If you remember at the beginning of the presentation, I think we got 15 grand in cash. So all in all, we're doing fine. We have cash and reserves. We're positioned for a bounce, and I'm going to show you that. Here is the Fed Chair, Jerome Powell, and here are the interest rates that were made in 2022 and 2023. The most recent one being July 26, 2023, 25 basis points. Here's your federal funds rate right here. The next FOMC announcement is September 20th. Will we have a 25 basis point rate hike or a skip? Right now, the odds favor there will be a skip. The Fed will skip this announcement on September 20th. Now we are looking at things from the presidential election cycle theory, which states, depending upon what year of the election you are in for the president, historical rates of return will apply. Currently, President Biden is in his 3rd year. Historically, that has had a return on the S&P 500 of 16.3%. Currently, the S&P buy and hold investor is up 14%. Allowing room for this to come back up to meet the historical average of 16%. Now we are looking at things from the bond market outlook, and we want to pay attention to the bond market because it's 4 times the size of the stock market, and the street says that the bond market is actually smarter than the stock market. Okay. So with all that said, last week we didn't have any data because bankrate.com. By the way, there's links of everything that I'm presenting to you in the description down below. If you want to explore anything that I'm presenting today, you go to the description. You can click on the link that takes you to all these pages that I'm presenting. So there you go. Last week we didn't have data because they did not provide updated. There was no data. It had zeros in the data columns. But now we have fresh data. Now, we still have an inverted yield curve. Yes, we do. Why is that? Because the 10-year yield, the longer-term yield, is yielding a lower yield than the shorter-term 3-month and 2-year yields. You can see that here. But I want you to notice this. Notice the 3-month and 2-year yields, how they have not really changed from 2 weeks ago to April 19th. But you do see a change of 20 basis points approximately in the longer term yields. So if this trend continues, then the longer term rates will begin to equalize and go and surpass the shorter term rates, which is a normal market, normal bond market. This is an abnormal bond market. So to be in a real true bull market for the stock market, we do need this yield curve to find and normalize. That's what we need that to happen. We want that to happen to have a real strong bull market in the stock market. In addition to an inverted yield curve, we also have rising interest rates. 10-year yield 1 year ago was 2.82. Today it's 4.21. That's a rising interest rate. Again, not favorable for a stock market equity investor. So we're watching this. Now we are looking at things from a valuation standpoint. The problem is that where I get this data from, which is CMV, and here's the link and in the description, they did not update their data. Their data is old, July 31, 2023. That's over half a month old. So anyways, this doesn't move much anyways on a month-to-month basis, so it's not the end of the world. Point is that we're overvalued on a PE, price per earnings ratio. We currently have 1.4 standard deviations on the standard deviation chart. So there's risk in the equity market. Now we are looking at CNN Business Fear and Greed Index. Here's our friend Warren Buffett. And you can forget about greed. Greed has come way down to we are just above the fear column, and we're at the bottom edge here of the neutral column. And just as Warren Buffett would say, be fearful when others are greedy, and be greedy when others are fearful. Well, others are getting fearful, and that is when I changed my tone and put more of a leverage towards the market going up rather than down. I still have cash reserves in play. If the market continues to fall off of a cliff, I can hold that cash till eventually this market finds a bottom and deploy that cash to put that money to work when the market does that. So we're in a very good, healthy position for this market. Now we are looking at things from a seasonality outlook. And this is going back 20 years, and the seasonality of SPY tells you you are currently in the summer doldrums, August, September, and October. August being the first month. So we have just started the summer doldrums. And when you see the chart of the S&P 500, you can see how the market is corrected, and just like here, has came down. So currently for the month of August, the S&P 500 is down 4.65%. You can see it in this nice red juicy candle right here. Now we are looking at things from a long-term outlook. This is a monthly chart for the S&P 500, and this is going back 20 years. And what do I say? I say we're in a bullish stance as long as we stay above this line and this line. Well, let's look at that. Since 2009 to 2022, we had an incredible run for the S&P 500. Then we corrected. We came down into this channel. When we broke out above that channel, that told me we've just begun a new bull market, which is what I'm saying. We are in currently a long-term bull market until or unless we break either this line or this line. You can see that since 2009, and we tagged it again briefly in 2020, this is a support line. So if we break that, we're breaking long-term support going back to 2029 on this trend channel. This line here is the more recent channel that we were in when we were correcting down and broke out above it. Now, it would not be uncommon for the market to come all the way down, tag the back half of this line, and then to continue on. But if the closer we get to it and if we break it, then the probabilities become higher that this market is in serious trouble. Now, the MACD is positive, but you can see it is completely flattened out here in the thumbnail, and it is going parallel to its signal line. I would not doubt that this comes back and crosses down below the MACD, kind of like where it went up and then came back down here. So we could start seeing some sideways action. So we are watching this to see how this plays out. Now we are looking at the intermediate term outlook, which I say is neutral. And these are weekly candlesticks, and we're going back 5 years, S&P 500. There's the all-time high. We never reached it, but we came super close. We did surpass this high here, but not this one here. And we were in that upper trading range for a few weeks, because this is weekly chart, okay? A few weeks, but we've come back down. So now we are trading in this new lower trading range here, where we did spend some time, had that nice bull run part of it. And there's a high that we made right there in 2022 in July, and we have not crossed down below that. But even if we do, there's another support level right here. January of 2023, I believe, well, it could be January or February, I'm not sure the exact month, but right here you can see more support. So we've got tons of support at approximately 427 and 419. We are currently at 436. So we are watching this. You can see that the MACD has topped. It is just about ready to cross below its signal line. MACD headed south below 80. All of these things suggest we are going to eventually come down and break down below these two lines here, or at least meet them. It would not be unreasonable for this market to come all the way down to this 390 level. That absolutely could happen between now and the end of October. But for right now, I'm expecting in the intermediate term a bounce up, not past this point here, but somewhere between its current level and this point. So somewhere in there is where we're going to top out. For this to be what I'm expecting, which is a longer term correction, for that to come and be a reality, for that to happen, we cannot surpass this high, because we have to make lower highs for the market to continue lower. If we start making higher highs, well, then that is going to negate my theory that we are going to come down and possibly tag this 390 level. So we're watching this to see how it all plays out. I am expecting in the next 2 to 3 weeks for this market to come up and bounce to some level before flattening out and crashing down. That's my personal expectation, and just because I expect it does not mean it is going to happen. We have to watch the market to see how it will actually happen, but my trading will be based off of that thesis, so we'll see how that plays out. Now we are getting more granular. We're looking at a daily chart only going back 6 months for the S&P 500. You can see the candlesticks here in the chart. This is a very busy chart. It has a lot of data on it, and I'm going to break it down for you. Now, I have changed my Fibonacci retracement. So I did used to have, this is the Fibonacci retracement here, which shows you the 38, 50, and 61.8. I did have it where we were capturing this low here. But when I was looking at the intermediate term chart, I'll show you that right here. So when you're looking at this intermediate term chart, you can see how the market has had, from this level here in 2022 of October, how it came and went up, had an 8% correction, came up here, had an 8% correction. Now we've come up this amount, no 8% correction between here and here. You have two of them here. This date here equates to this date right here, March 13th. So I put my Fibonacci retracement capturing the March 13th as the low, and the high was the recent high made after March 13th, which is this high at this candlestick right here. So that is where we got our full Fibonacci retracement. Now, that brings the 38.2 to 428, and it brings the 61.8 down to 408. And 408 has a lot of support coming towards it. So I would not be surprised for this to come eventually all the way down to this 61.8 retracement, which is right here. Now, an 8% correction for the stock market, which is what those other two corrections were, would take us to this level here, which takes you to this support level, which is about the 425. Now, currently, we are at the 436.5, which is this level right there. But we did come down on this candlestick, which is Friday's candle, and we did have a correction from peak to trough of 5.8%. That's the correction that we made so far. Another thing that I want to point out, you see these green trend line going this way? So the market was in this healthy bull run inside of these green trend line until this trend channel, till it broke down and then came out of it. Now there's a new trend channel that I put in red here and here. We are currently in this trend channel until we are no longer in it, either breaking down out of it, or we stay in it, or we break out above it. My expectation is that we are going to break out above it, or at least reach it. And I know that we are not going to, I strongly suspect that we are not going to surpass that old high that I showed you. And just for clarity, that high is this high right here, which is at approximately 460. On this chart, the 460 is right there. So I don't expect us to beat this high, but I do expect the market to come up to this trading range right about here. Somewhere where this dashed orange line is right here is where I expect the market to come and stop out and then begin to roll over. We'll see if that actually plays out. Now, what is this dashed orange line here and here? Well, I did purchase 200 shares of SPY at 448.76. That is this dashed orange line. That's my buy price for SPY. But my break-even price is not the same because I have been selling calls against my shares. My break-even price is at this dashed orange line right here. You can see that it is just above where we are currently trading. So it will not take much for me to get to a break-even and profitable on my shares of SPY. So I'm monitoring this, and that's taking my call selling into account. So, and that by the way does not even have anything to do with my long call position, because I'll also make money on the long call as well. Okay, so that is where we stand. You can see some of my trades. I put them in here in the chart as well. And that is where we stand on this 6-month chart. A lot of information. Now we are looking at a ratio chart with the equal weighted S&P 500 RSP compared to the normally weighted S&P 500 SPY. There are 3 charts in this chart. The ratio chart is the one with the red and black lines. The normally weighted S&P 500 is in blue. The equally weighted S&P 500 is in green. The bull market from 2009 to 2020, you can see where the green rose above and consistently stayed above the normally weighted. So the point is that the green is above the equally weighted S&P 500 in a healthy bull market is above the normally weighted S&P 500. Now, we have fallen off of a cliff on the ratio chart 3 times. Here, here, and now again here, which is right where we are at. The last 2 times we went sideways for months. Sideways for months. We're going sideways right now, but the time duration is nowhere near the same time duration. In addition to that, when the ratio chart fell off a cliff here and here, the S&P 500, which is the blue line, you can see it here and you can see it here, also fell off a cliff and also fell off of a cliff. We have nowhere near fell off a cliff recently. We've just softened up. Nothing but so far average pullback. Absolutely nothing. Nowhere near falling off of a cliff. Falling off of a cliff would be large red candles. We're not experiencing that yet. We may experience that, but we're not experiencing it yet. So we're watching this. MACD is still positive, but has severely changed its angle of ascent, and I would not be surprised for it to come back down and cross below its signal line. We are closely watching this ratio chart. And when this ratio chart allows some time to go by and we get into that bull run, and we are in this nice bull run for the S&P 500, my expectation is that we will profit very handsomely when we do that. Right now, the market is in a little bit of turmoil. We have a lot of things, a lot of headwinds against us with the inverted yield curve. Ratio chart not really panning out exactly right. Interest rate market not being exactly the way we want it to go. So there's a lot of headwinds that we're up against, but we're watching this closely. Now we are looking at the VIX volatility index, the fear index. Remember, the VIX, when the VIX goes up, that's these candlesticks. The S&P 500, which is this black line, goes down. So you're going to lose money when the VIX goes up. You're going to make money if you're long the S&P 500. You're going to make money when the VIX comes down. This is the easy money. When the VIX comes down, you can see right here the S&P 500 took off. Right now, the VIX is coming up, and the S&P 500 during the same time frame has come down, but it's only come down a few percent. Nothing crazy. Okay, we certainly haven't fallen off of a cliff by any means. Just this is normal pullback. That's all we've seen so far. Now, the only concerning thing I have in this chart is this part right here. This is where the MACD on the VIX came down, was approaching its signal line, never did, turned the opposite way and went up. That's bullish for the VIX, which is bad if you're going long the S&P 500. So I might be a little premature in my closing out of the option and also taking on that call option, because if this market doesn't turn around soon, and the look of this MACD is telling me that it may not, there may be another week or more of downside pressure before this market turns around. And if that's true, of course, I'm not going to be a happy camper with a long call, but I have cash reserves if that indeed does happen. So this is the worst part about this. But this is all lagging indicators. The VIX and the MACD, these are lagging, not leading indicators. So the market can turn around come Monday. So we'll see how that plays out. We were in this, what I call a low trading range between 16 and 20. Then we dropped down to this ultra low. And that's when the market really took off. You see, when you're in this ultra low, the market goes up. But right now we are here. Now, did we, on this last candle, which is daily candles, on this last candle, did the VIX reach a rejection and is now heading down? You can see that that's a pretty good candle to show that it potentially did reach a resistance level right here. So we'll see what happens come next week. Now we are on the Think or Swim platform. 1 year chart, S&P 500, and here we have standard deviations. 95% of all trading takes place between the +2 and -2. 65 to 67% of all trading takes place between the +1 and -1, which is in the pink right here. I also have the 50-day in green and the 200-day in black. Currently, we are trading below the 50-day. Normally, not a great sign. We have traded below it before, came up, and then traveled higher north even after that happened. But when you are traveling in the opposite direction and you're below the 50, risks can be elevated. So we do want to watch this. Now on the 1 year chart, for the standard deviation, we're at the -0.2 standard deviation. We're just below the 0 line. Now we are looking at a 6-month chart, and we have the standard deviations. Here on this chart, we are at the -1 standard deviation. So the odds on the shorter term chart are going more in our favor that we're going to get that bounce that I've been wanting. Now we are going down a little more granular, 3-month chart. So going back 3 months, the -2 is in gold. We are very close to reaching the -2. Now, keep in mind that the shorter the chart is, the less valuable the standard deviation information is. So on the 1 year chart, because we have more time, more data, more bars in the chart, the the standard deviation is a little bit more valuable than the shorter term chart, 3-month chart, because it's only 3 months worth of time, 3 months worth of data. But hey, in the last 3 months, we've never been below, this much below, the -1 standard deviation. So there is some meaning to even the 3-month chart, and we'll see how the actual S&P 500 respects this -2 standard deviation during the week, and I'll show you that in next week's video. I have just given you a ton of information in this video. What are you going to do with that information? Here is the critical thinking. As of August 19th, 2023, market summation according to Ken, which is me, with SPY Trader Now, the market has dropped 5.8% from its recent high on 7/27/23. We are at the -2 standard deviation on the 3-month chart, and we are due for a bounce. I'm expecting a bounce, folks. I have taken a long call trade to profit on this bounce. I've taken actually three option contracts, but my position is small. When I took on that position, I put $1,000 to work in our entire portfolio. $1,000 is less than 1%. So even if for some reason I'm not even going to be profitable in this option trade for the 3 contracts, it would still not hurt me that much. I would lose $1,000 because you can't lose more than what you put into on going long on your options. So we're at the beginning of the summer doldrums, as I showed you on that chart. So stay tuned. Let's see if what I told you is actually going to pan out, or exactly how the market is going to pan out. Keep in mind, the market is an 800-pound gorilla, and it will do whatever it wants to do whenever it wants to do it. And even though I may say, oh, I expect this, I want that, the market will dictate exactly what it will do. And I'm trading around what I observe and what it is actually doing. So I hope I have given you some valuable information in this video. If you want to learn more about me, you can head over to spytradernow.com. There's a link down below. If you have not done so already, hit that subscribe button, ring that bell, and help me promote this video by smashing that like button down. I thank you, and I wish you good trading.